On paper, starting a private security company sounds like one of the simplest, most foolproof businesses in the entire modern economy. You register a limited liability company, purchase a stack of black polyester uniforms, buy a dozen two-way radios, hire a crew of hourly guards, place them outside corporate buildings or distribution centers, and collect a recurring monthly check. It feels like the ultimate cash flow utility. You are essentially renting out human bodies by the hour, and because crime, theft, property loss, and liability never sleep, demand for protection never disappears. In the United States alone, the private security industry employs nearly 1 million security guards spread across more than 100,000 separate operating companies. Globally, the market is valued at well over $185 billion. That is not a niche cottage industry. That is a titan, bigger than the entire domestic airline catering sector, bigger than movie theater box offices, and bigger than commercial fitness chains combined. So, here is the terrifying financial puzzle that should haunt every entrepreneur before they sign their first client contract. If global demand for physical security climbs higher every single year, through economic booms and deep recessions alike, why do thousands of private security firms barely scrape by? And why do so many operators go bankrupt while holding multi-million-dollar corporate contracts right on their balance sheets? The answer lies in a dirty operational truth that standard business textbooks never mention. When you win a major security contract, you haven't secured a gold mine. You have inherited a high-stakes, hyper-fragile financial machine where a single missed shift, a 90-day invoice delay, or one bad employee decision in a courtroom can obliterate an entire decade of profit in a single afternoon. Let's trace the journey of a single dollar inside a brand new corporate contract. Imagine your sales team just scored a landmark deal with a massive regional distribution facility. The signed agreement guarantees a bill rate of $35 an hour for every guard post on site, totaling over $1 million in gross annual revenue. You frame the signature page and hang it in your office lobby. Now, let's look at the naive math that lures beginner operators into bankruptcy. You hire an unarmed security guard at $20 an hour, roughly the going market rate in a mid-sized American suburban hub. You subtract $20 from your $35 bill rate, look at the $15 difference, and assume you're pocketing a massive 42% gross profit margin. That assumption is a financial fantasy. That $20 hourly wage is merely the starting point of what economists call the fully loaded labor cost. Before that, guard steps onto the client's concrete floor. Federal and state statutes immediately start chipping away at your spread. First, federal payroll taxes hit you for roughly 7.5%. State and federal unemployment insurance reserves take another 3%. Then comes the real crushing weight: workers' compensation insurance. Security work is classified as a physically confrontational, high-risk occupation. If a guard slips on ice in a parking lot, gets into a physical struggle with a trespasser, or injures their back while inspecting a trailer, your insurance policy pays out. Because of that physical risk exposure, commercial insurance underwriters charge security firms elevated premium rates, often running 18% or higher on top of base wages. By the time you add compulsory payroll taxes, unemployment funds, and workers' compensation, that $20 an hour guard is costing your company nearly $26 an hour in direct, unavoidable cash expenditure. And you still haven't provided them with a uniform. You haven't bought their two-way radio, covered their state security licensing fees, paid for their criminal background check, or contributed to your general liability insurance policy. You haven't paid for the GPS patrol tracking software that client managers demand to verify your guards are actually walking their routes. Nor have you paid your dispatch team, your payroll accountants, or your office rent. When you subtract all those operational overhead costs from that $35 bill rate, your glorious $15 margin evaporates. What actually lands on your bottom line as net operating profit is somewhere between $2 and $4 an hour per guard. Think about that risk-reward ratio. You are carrying absolute legal, financial, and physical liability for an entire industrial facility, and you are netting $3 an hour. If thin margins were the only problem, companies might still manage. But the ultimate killer of security companies isn't profitability, it is the brutal mismatch in cash flow timing. Your guards are hourly workers protected by strict federal labor laws. You must pay their wages every single week, or at most every 2 weeks. There is zero flexibility. If you fail to meet payroll on Friday, your guards do not report on Saturday, your client cancels your contract by Sunday, and the Department of Labor launches an investigation on Monday. Your corporate client, however, operates on a completely different timeline. Large corporations and municipal agencies process vendor accounts payable on 60-day, 90-day, or even 120-day payment cycles. Walk through the real cash consequences of that gap. You deploy 10 guards on a new multi-site contract. You pay those 10 guards out of your bank account every Friday. By the end of month 2, you have paid out $60,000 in cash wages, payroll taxes, and fuel. Yet, your business has received exactly $0 in cash payments from the client. Where does an independent operator get $60,000 of liquidity to bridge that gap? Most don't have it sitting in cash reserves, so they turn to financial institutions for accounts receivable factoring. A factoring lender advances you cash against your unpaid client invoices, but they charge a steep financing fee, typically taking 2 to 4% of the invoice value for the privilege. Look at what just happened to your numbers. You were already operating on a knife-edge profit margin of $2 to $4 an hour. When you pay a factoring company 3% to access your own money early, that financing charge wipes out your remaining net margin. You are now working for free, running a high-risk operational engine just to service a lender's interest rate. Because a security company is built entirely on physical human presence, it inherits all the unpredictable chaos of human behavior. In a software company, if an engineer calls in sick on a Tuesday morning, software code still runs on the server. In a retail store, if a cashier is late, another employee opens a second register 20 minutes later. But in private security, your client contract contains a strict, legally binding clause known as mandatory post coverage. If a client pays for a guard to stand at gate 3 from midnight to 8 in the morning, that post cannot sit empty for 5 minutes. An unstaffed post is a direct breach of contract, resulting in immediate financial penalties, client termination, or massive legal exposure if a break-in occurs. Now, imagine it is 3:30 on a freezing Sunday morning. The guard scheduled for the graveyard shift at an auto storage depot texts their supervisor to say they aren't coming in. What happens operationally? The field supervisor scrambles. They call off-duty guards, but nobody answers at 4 in the morning. Desperate to keep the post covered, the supervisor orders the guard currently finishing the evening shift to stay on site and work a double shift. That single operational decision quietly destroys your weekly profit statement. Under labor regulations, working 16 consecutive hours or going over 40 hours in a single week triggers mandatory overtime pay at 1.5 to 2 times the base wage rate. Instead of paying $20 an hour for labor on that shift, you are now paying $30 to $40 an hour. Remember, your client bill rate remains strictly locked at $35 an hour. On that single night shift, your labor cost completely swallows the client bill rate. You didn't just lose your $2 an hour profit margin, you actively paid money out of your pocket for your employee to stand on that client's property. One overtime shift on a weekend can easily wipe out the entire net profit generated by 5 other fully staffed, perfectly operating guard posts across the entire week. This financial bleeding reaches critical levels during major holiday seasons. On Thanksgiving, Christmas, or New Year's Eve, almost every guard requests time off. To incentivize staff to cover shifts, operators must offer holiday premium pay. If your client agreement doesn't feature an explicit holiday billing surcharge clause, holiday staffing costs alone can wipe out an entire quarter's accumulated earnings in 48 hours. To prevent these constant overtime emergencies, the logical solution seems simple. Just hire a larger bench of backup guards. That is where you run headfirst into the recruiting crisis that plagues the entire security industry. Hiring a security guard is brutally inefficient and expensive. Because guards hold positions of trust, law requires thorough criminal background screening, multi-panel drug testing, state fingerprinting, and specialized licensing certification before a new hire can perform 5 minutes of billable work. To hire one qualified, fully licensed guard, a human resources team must screen dozens of applicants, process background checks, pay state regulatory fees, supply uniform suits, and conduct paid orientation training where the candidate generates zero billable income. And after spending hundreds of dollars to get that guard fully certified and onto a site, statistical reality strikes. Annual employee turnover in the private security industry routinely hovers around 100%. In high-density metropolitan markets or low-wage sectors, turnover spikes well above 120% every year. That means a security enterprise effectively replaces its entire frontline operational workforce every 12 months. If a guard quits 90 days after being hired, which happens every day across the country, the company never recovers the upfront recruitment, background check, and licensing capital spent to onboard them. The firm is locked in a perpetual cycle of burning cash on onboarding, only to watch that human capital walk out the door 3 months later. Meanwhile, modern operational technology has added another layer of legal exposure. To prove to clients that guards are actively patrolling, companies deploy mobile software that tracks movements via GPS and requires guards to scan digital barcodes placed at strategic physical checkpoints. On paper, this software reassures clients. In reality, it creates a paper trail that can be weaponized in court. If a warehouse is burglarized at 2 in the morning, the client's insurance investigators immediately subpoena the security firm's digital GPS logs. If those logs show a 15-minute gap in patrols, perhaps because a guard fell asleep, stepped away to use the bathroom, or skipped a checkpoint, that digital record becomes Exhibit A in a negligence lawsuit. The software designed to prove you were doing your job becomes the very evidence used to destroy your company. Everything we have discussed so far, thin profit margins, 60-day payment lags, overtime drain, and rapid turnover, represents the slow, daily grind of operational erosion. But there is a nuclear threat hanging over every private security business that can destroy a 20-year-old firm overnight. It is a legal doctrine known as negligent hiring and retention liability. When a property owner hires a third-party security company, they are delegating authority over physical access to their land, assets, and occupants. If a security guard deployed on that property commits an act of violence, sexual assault, theft, or severe misconduct while wearing your uniform, civil law allows the victim to sue the security company directly. In court, liability doesn't just depend on whether the guard committed a crime. The central question becomes, what did the security company know about this employee before giving them a badge? And more critically, what should the company have known if it had performed a rigorous screening process? This is not a theoretical law school hypothetical. Consider a real precedent-setting case that sent shockwaves through the American corporate landscape. A jury in Missouri handed down a staggering $177 million judgment against a major corporate enterprise after an on-duty contracted security guard sexually assaulted a guest inside a hotel room. When plaintiff attorneys dissected the case, the operational failures were damning. The guard had a documented history of prior criminal arrests for sexual misconduct, a red flag that a thorough background check would have flagged immediately. Furthermore, the management team failed to properly supervise the guard's night shift movements and was found to have obstructed the police investigation after the incident occurred. The jury awarded $28 million in compensatory damages to the victim. Then, to send a punitive message to the corporate ecosystem, they added $149 million in punitive damages. $177 million. Now, recall the numbers of a typical mid-sized security operation. Contracts yielding $2 to $4 an hour in net operating profit, struggling to cover weekly payroll while waiting 90 days for invoices to clear. A single catastrophic verdict like that isn't a bad financial quarter. It is an immediate extinction event. Even when judgments are smaller or covered partially by liability insurance, the financial aftermath is fatal. Following a major incident, a security company's commercial insurance carrier will either cancel coverage outright or skyrocket annual premium rates by 500%. In the commercial security ecosystem, operating without comprehensive general liability and aggregate umbrella coverage is illegal. The moment your insurance policy is cancelled, state licensing boards revoke your corporate security license. Within 24 hours, your business is legally barred from operating. This creates a terrifying economic asymmetry. You are taking on near-infinite legal risk, putting your entire corporate solvency on the line every single night in exchange for a razor-thin operating margin. You are taking on the risk profile of a major insurance underwriter, but collecting the compensation of an hourly staffing agency. Given the crushing weight of labor costs, cash flow delays, turnover hell, and nuclear legal liabilities, you might wonder why anyone continues to invest in private security. The answer is that the smartest players in the industry are quietly abandoning traditional guarding altogether. They are executing a massive operational shift toward technology-driven remote video monitoring and software-enabled protection. To understand why this technological pivot is reshaping corporate valuations, you have to compare the unit economics of the two models side by side. A traditional guard company's financial growth is strictly linear and labor-bound. If a traditional company wants to double its annual revenue from $5 million to $10 million, it must roughly double its physical headcount. It must hire twice as many guards, buy twice as many uniforms, pay twice as much in workers' compensation premiums, process twice as many background checks, and take on twice as much negligent hiring risk. Because every dollar of new revenue requires a matching unit of expensive human labor, a traditional guarding business hits a permanent ceiling on efficiency. After paying all operational expenses, a traditional firm operates on a lean net margin of 5 to 7%. Now look at a technology-driven remote monitoring firm. Instead of placing 5 physical guards at a commercial logistics yard overnight, a technology company installs an array of high-definition thermal cameras, motion sensors, and AI-powered video analytics connected to a centralized remote monitoring center. When software detects an unauthorized intrusion at 3 in the morning, an alert flashes on a computer screen in a command center miles away. A single human operator reviews the video clip in 3 seconds, confirms the intruder, and uses a loudspeaker to warn the trespasser while dispatching local police. The financial difference between these two models is night and day. A remote monitoring company breaks the link between revenue growth and headcount. A single monitoring operator sitting in a central control room can oversee 20 different commercial properties simultaneously. To double its revenue, a monitoring firm doesn't need to double its staff. It simply needs to install more camera nodes and purchase additional software user licenses. Because software and camera feeds scale infinitely with low incremental cost, technology-first security companies operate on net profit margins exceeding 30%, roughly 4 to 6 times the profitability of a traditional guard provider on the exact same core promise of property protection. Wall Street and private equity investors view these two businesses through entirely different lenses. When a traditional guarding business is bought or sold, market valuation multiples hover at a modest 4 to 6 times annual earnings before interest, taxes, depreciation, and amortization or EBITDA. Investors view physical guard operations as fragile. Commodity staffing agencies plagued by client churn and wage inflation. In contrast, technology-driven monitoring companies command enterprise valuation multiples of 12 to 16 times EBITDA. Investors pay a premium because monitoring businesses generate high-margin, recurring software subscription revenue backed by sticky, multi-year technology service contracts. You can see this strategic reality playing out among the world's largest security conglomerates. Industry giants like North America's Allied Universal carry massive debt loads exceeding $10 billion to maintain their massive scale, managing hundreds of thousands of hourly guards while wrestling with perpetual 70% turnover rates. Scaling physical labor creates scale, but it also compounds operational friction. Meanwhile, European security giant Securitas executed a decisive pivot. To free itself from thin-margin manual guarding contracts, Securitas spent over $3 billion acquiring electronic security specialized firms focused on automated access control, commercial alarm integration, and remote video monitoring. That massive technological acquisition pushed Securitas's corporate profit margins above levels where traditional guard operations had been stuck for over a decade. The executive board recognized a fundamental truth. The fastest way to make a security enterprise profitable isn't hiring more humans, it is replacing human hours with digital surveillance assets. The final structural trap waiting for physical security operators is the long-term fixed contract. Commercial and government security contracts typically lock in client bill rates for 3 to 5 years. A fixed contract sounds like guaranteed long-term stability until macroeconomic reality intervenes. Between 2021 and 2024, average hourly wages for security personnel across the United States rose sharply from roughly $17 an hour to over $21 an hour due to broader labor market inflation. If your company signed a 5-year contract in 2021, locking in a bill rate of $25 an hour without an explicit wage index escalation clause, you spent the next 3 years trapped in a financial vice. You were legally obligated under client contracts to maintain physical staffing and legally required under labor markets to pay rising wages to attract guards. Your thin profit margin didn't shrink, it went negative, forcing you to fund client security out of your cash reserves until the contract expired. Now, let's pull all these threads together to see what owning a $10 million private security firm actually looks like in the real world. Assume your enterprise manages a portfolio of commercial contracts generating $10 million a year in total client billings across warehouses, retail centers, and office parks. In an ideal, perfect year where wage inflation stays calm, employee turnover remains low, no guards call in sick on holidays, client invoices are paid promptly, and no legal incidents occur, your careful cost management yields an 8% operating margin. That leaves your company with $800,000 in net profit before taxes and debt service. That is a fantastic outcome. Now, run that exact same $10 million portfolio through a realistic year on Main Street. Wage inflation pushes your fully loaded labor costs up by 8% on fixed-rate contracts you cannot reprice for another 18 months. High annual employee turnover forces your HR department to spend heavily on continuous background checks, drug screenings, and paid onboarding hours. 3 major holiday shifts suffer guard no-shows, forcing field supervisors to pay double-time overtime wages to keep posts covered. Under those standard operational conditions, your 8% profit margin doesn't just dip to 5%, it drops to negative 2%. On the exact same $10 million billing volume, your business goes from making an $800,000 profit to suffering a $200,000 net cash loss. That $1 million swing between profit and loss isn't caused by a failure to sell, it is caused by the brutal operational volatility built into the DNA of physical labor rental. This reality explains the silent revolution reshaping the future of the industry. To staff a single security post 24 hours a day, 365 days a year, requires roughly 5.5 full-time guards to cover all 168 hours in a week, while accounting for vacations, sick leave, and mandatory training. Providing that human presence costs a property owner between $140,000 and $280,000 every year for a single site. An automated remote monitoring network covering that exact same location costs between $12,000 and $30,000 a year after initial hardware setup, a cost reduction of 60 to 90%, while delivering continuous coverage that never suffers from fatigue, never calls in sick at 3 in the morning, and never triggers a negligent hiring lawsuit. The mistake outsiders make when analyzing the private security industry is assuming the product being sold is the guard. It isn't. The product being sold is a reduction in someone else's corporate risk. It is a lower property insurance premium, protection against legal liability, and peace of mind for a facility manager. The security operators who thrive tomorrow won't be those who rent out the most human hours. They will be the ones who master technology, eliminate operational friction, and realize that in a business built on preventing disaster, the most profitable asset isn't a body at a door, it's the smart system that makes disaster impossible. If you want to master the financial forces shaping businesses across Main Street and Wall Street, make sure to hit that subscribe button, turn on notifications, and share your thoughts in the comments below. This is the World Money Desk. Stay sharp, stay authentic, and we will see you in the next deep dive.